Ladies and gentlemen, welcome to the ultimate financial showdown. In the blue corner, weighing in with unlimited profit potential and massive leverage, the buyer. And in the red corner, defending the high probability title, the master of time decay and consistent cash flow, the seller. Let's get ready to rumble!
Behind this match, it's not about punches. It's pure math and probabilities. One side is paying for the ticket, while the other is collecting the rent. Today, we're breaking down the mechanics of both camps so you can see exactly how this options business works. Inside the options market, a silent war is fought every single second. In the left corner, we have the buyer, the hunter of explosive profits, looking for massive leverage with minimal capital. In the right corner, we have the seller, the casino, the cold mathematician who just wants time to tick away. One wants action, the other wants consistency. Today, we're stripping back the mechanics of both sides to see who actually walks away with the cash at the end of the month. The buyer seeks massive leverage, pays a small premium for unlimited upside. Risk is strictly capped at the premium paid. Time and volatility constantly bleed the position. The seller operates like an insurance company, collects cash up front and lets the math win. High probability of profit. Time is your greatest ally. Theoretical high risk if the market suffers a violent black swan event. The buyer is the one purchasing the ticket. Let's say you want to control 100 shares of a stock at a fixed price, but you don't want to tie up thousands of dollars of your capital. You pay a small premium, say $100. If the stock explodes to the moon, your profit has no ceiling. Your risk? Just that $100. Sounds like the perfect deal, right? Well, here is the subtle trap most retail traders fall into. The seller doesn't try to guess the exact direction of the market. They sell probabilities. The moment the buyer pays that $100 premium, that cash hits the seller's account instantly. For the seller to keep 100% of that profit, the stock just needs to not explode. It can move sideways, it can drop, or it can even go up just a little bit, and in all these scenarios, the seller wins. Options trading, when done right, is a mathematical business of collecting rent. Why do most option buyers lose? Because they are fighting two invisible killers, time decay and implied volatility. Every single night while you sleep, a bought option loses value. Time is the buyer's oxygen, and the clock is ticking. For the seller, every flat day in the market is a guaranteed payday. So who wins? Statistically, sellers hold a massive probability edge. That's why professional retail traders focus on generating consistent cash flow by selling spreads or running the wheel strategy. But buying isn't completely dead. If you buy long-term options, known as LEAPs, you can use them as stock replacements in a poor man's covered call setup to harness leverage while neutralizing time decay. Which camp are you in? Do you chase the adrenaline of buying, or do you prefer the mechanical consistency of selling?